Most investors have no idea they're paying extra taxes every single year. Not because they screw up their tax returns, but because of how they invest. I'm talking about something hiding inside of millions of portfolios across the country. Mutual funds. When we think of mutual funds, we think diversified, actively managed, safer than a stock, right? But what if I told you that even though they yield the same rate of return as other investments, you could still end up with less money over time? Today we're going to show you how something called tax drag quietly eats into your returns, and how building your portfolio the wrong way can cost you in ways that are hard to see. Tax drag is one of the least talked about performance killers in investing. It's the slow erosion of your returns caused by phantom taxes on capital gains distributions. Taxes you owe even when you didn't sell anything. Mutual funds are built on a system that's decades old. When the mutual fund manager sells shares to protect the fund during market drops, or when the mutual fund manager exchanges out stocks within the fund or rebalances the fund, those trades then tax the shareholder of record, which is you, even when you didn't sell anything. Congratulations, you just paid tax on a distribution you didn't need. Now compare that mutual fund to an ETF or an exchange traded fund. When an ETF exchanges stocks, the fund can use what's called an in-kind redemption process, which basically swaps the stocks instead of selling them for cash. So you could invest in the same markets, same stocks, and experience a completely different tax outcome. Let's look at an example where we compare a mutual fund versus an ETF. Now take the AGTHX, one of the biggest mutual funds out there. Now in this example, it's the black line. And every mutual fund that has a distribution, those distributions occur at the same time each year. It's either the last week of November or the first week of December each and every year. Now in 2024, this fund incurred a long-term capital gain distribution of $6.38, which you, the shareholder of record, paid. Now, the unfortunate thing is that distribution occurred at the exact same time that the stock market was taking a drop, which caused this fund to fall more than normal. Compare that to an ETF, which is the blue line, which in this case we're going to use the SPY, SPY, the ticker symbol. Between the two, the mutual fund and the SPY, they have similar market exposure, but much lower turnover and virtually no capital gain distributions in the ETF. Now, both of these funds track large cap growth. Both had solid performance, but one quietly hands you a tax bill every year. The other lets your money keep compounding inside the fund. Add that to the fact that the AGTHX charges about 0.61% each year in fund expenses versus roughly 0.09% for SPY. You've got performance drag that has nothing to do with market returns. Now let's zoom out 5 years. The annual distribution in your mutual fund really starts to make a dent in your net return. And 10 years? Well, it's no longer even pretending to keep up with its benchmark. Now, before we get a flood of comments, not all mutual funds are bad. There are specialized funds and tax overlays and mutual fund vehicles that make sense inside of IRAs and 401ks where taxes aren't an issue, and we'll touch on some of those in future episodes. The point isn't to ditch every mutual fund you own. It's to be aware of the hidden costs and to understand the purpose in your portfolio. Because if you want tax efficiency, structure matters. Hey, if you learned something new today, give the video a like, hit subscribe, and share it with someone who still thinks mutual funds are the default answer. Because for many investors, that default comes with a hidden tax bill.